The Rebel Capitalist Show.
Okay, I want to switch it up a little bit and go to a conversation that you had with Emil, and I think it was with Steve the other day as well, where you guys are talking about dollar shortages with Japanese banks. And when I was listening to that podcast, and I listened to almost every episode of Eurodollar University. But when I was listening to it, I'm like, okay, if I'm a bank in the Eurodollar system, theoretically, I can create as many new dollars as I want. That's what they do, is they create dollar-denominated loans. And I think, okay, well, if I'm two banks that have a relationship, and I forgot what's called. What's it called? A NOS account, a VOS account, something like that. But if you and I own banks, separate banks, and then I can say, okay, Jeff, I'll just set up an account. You have a checking account with me, and we'll put $1 million in it. You do the same thing. Now, all of a sudden, we've got $1 million asset, $1 million liability. We're good to go. So we just created $1 million for ourselves to go ahead and do whatever we need to do with it. So I'm thinking, okay, from that standpoint, there's really not a dollar. You can't have scarce dollars or a lack of dollars, because they can create these dollars at will. It's just maybe there's an issue with counterparty risk, so they're not willing to create the amount of dollars that are needed, therefore a dollar shortage. So let's go back to these Japanese banks. Why are they short of dollars if they can create those dollars? Is it that they're not plugged in to the Eurodollar system, to where they don't have those relationships required to be able to do that transaction like I described, where you and I own banks, and I just set up an account for you and post $1 million in there, and you do the same for me? Or you see where I'm going with that? Yep.
And I think that's the pre-crisis way of doing business, is that there was a lot of unsecured business where, the analogy that you just produced is that, hey, George, I know you, we've been doing business forever. I'll just create a liability. I get an asset, you get a liability, and everybody's happy.
Everyone's got the dollars they need.
Yeah, that sort of died out over the last 15 years because there are internal constraints to creating dollars. It is not, I guess theoretically, dollar creation is unlimited. Even in the pre-crisis era, that wasn't entirely true. There are constraints on balance sheet.
What are the constraints?
Dollar creation. They're internal constraints. There's risk budgets, there's risk controls, there's all sorts of committees. In the pre-crisis era, these were not so onerous that they got in the way of banks experimenting and doing risky things, because back then, recency bias and confirmation bias, everybody thought, well, I'll look at what you're doing. You're creating $1 million asset, which is a liability for you. There's a little bit of risk there, but we don't see any risk because there hasn't been anything that's gone wrong in forever. We're not going to stand in the way. You do whatever the hell you want. Since 2007, that's no longer the case. In fact, most banks operate very differently, where there's now layers of compliance. There's layers of accountants. There's layers of regulatory checks. There's all sorts of things that prevent banks from just saying, I'm going to do this because I think I can, or I think I want to. Now you have to live within, say, a risk-weighted asset budget. You have to live within a very much tightened internal control environment, something like Vega or VAR, something simple like VAR, where I look at you and I say, George, I know we've been doing business for a long period of time, and I want to give you this $1 million.
Right.
But we've done all our black box calculations, and the risk-adjusted return doesn't make it worth it for me to do this, because then I'd have to justify to the compliance manager why I'm doing something that the models are telling me I'm not getting paid enough for.
Right.
So in order for you and I to do this, you got to offer me a much bigger spread in order for me to give you this $1 million.
Yeah, because the perceived risk side of the equation increased exponentially since 2007, because they didn't think that type of risk existed. Now they understand that type of risk exists, and they need to be compensated for it. And so it's not really a matter of a dollar shortage. It's a matter of confidence in counterparty risk shortage.
Which is the same thing. You're basically saying the same thing in different ways. And it's really a balance sheet shortage is what we're really talking about. It's not there's a lack of physical dollars because nobody uses physical dollars. It's a lack of the willingness and the ability of the banking system to create additional dollars in response to market changes. These are dynamic conditions, remember? So what we may have been doing yesterday was perfectly fine given the black box model calculations that my firm has done. But then something changed. Today, we look at some of the markets and some of the signals, correlations are going up, whatever it might be. Suddenly, the black box model says that loan you were doing with George yesterday, if you want to do it today, you got to charge them an additional premium, or you've got to add some collateralized component. You've got to add something that makes it either lower the risk or raise the return. And if you're in a collateral constrained environment, or your own balance sheet constrained environment, you're not going to be able to do that so easily.
Yeah,
so
that's the mismatch between needs and collateral.
Right.
Liquidity needs and collateral, yeah.
If you're the Japanese bank and I'm knocking on your door saying, we did this loan yesterday for $1 million. Today, in order for me to do this $1 million loan, you've got to pay a ridiculously high interest rate, or you got to make it secure for me, which means I'm basically telling you to post collateral or we can't do business anymore. And if you don't have the collateral, what are you going to do? Well, you're going to go find somebody else, but in a collateral constrained systemic environment, nobody else has collateral to lend you. So you're kind of stuck, which means you're left with only bad options, including paying through the roof for collateral rental rates, or in the most extreme cases, you start fire sailing assets, which only contributes to the self-reinforcing vicious cycle, because as you're fire sailing assets, asset prices fall, liquidity in those markets fall, more asset sales, and
the counterparty risk increases.
Absolutely.
Yeah, which so you need more collateral. So then there's more demand for collateral.
We need more collateral, and just round and round and round it goes.
Yeah. So the next question I want to ask is, what do you think the probabilities are that the United States is in a recession or going into a recession? Probably a softball there. And then on top of that, what do you think the Fed's response is going to be? And maybe more importantly, the government's response, because I try to think through this from a standpoint of inflation, disinflation, deflation. So if we're going to assume that, let's say there's a 90% probability that we're headed for recession, and that's what the curves are telling us, that the Fed's going to drop rates back down to zero. And why would they do that? Because there's some serious economic problems that we're going through. And then you got to say, okay, well, then what's the government's response? And then is it going to be a CARES Act 2.0? And then do we get a decade that looks a lot more like the 40s instead of the 70s? And I know you know what I'm referring to there.
Yeah. And I think that's really where we're going here. Okay, first part first. I think that there's nothing is ever 100% certain, but in terms of economic probabilities, a recession is about as close as it's going to get. And I would wager a significant amount that recession began around March, maybe April, perhaps May. Over the last few months, we see a lot of economic data just fall off a cliff. And you've seen some really sharp changes, for example, in labor market data, which is usually a lagging to coincident indicator.
Right.
The household survey dropped in April, came back a little bit in May, and then dropped again in June, which is highly unusual to see those levels of declines for a 3-month period. In fact, you have to go all the way back to 2010. So something very serious changed. Jobless claims have been rising. Yes, they're at a low level. They're at extremely low level, but they've been rising steadily ever since the end of March. So there is a very decent chance that the U.S. entered a recession. As we said, we're already going to see probably 2 negative quarters in a row of GDP, sort of as the appetizer to the actual recession entree that's upcoming. So the fact that, if we aren't in a recession now, then the second half of the year is about as close to.
And Jeff, also talk about, and we're going to get into the monetary and fiscal policy in a moment. Let's remind me to circle back, but talk a little bit about the inversions increasing. And what I mean by that is we started with probably the 5s and 10s or something. And then that moves to the 2 year, and that used to the 1 year. Now I just checked it. I had some buddies in town, so I haven't been able to really check the data since.
That's not what you do with your friends, sit around and watch the yield curve all day.
We were,
it's just me.
yeah. No, we were having a good time. We were renting ATVs and, going out and drinking and going to barbecues and whatnot. But anyway, on Sunday, I looked at and I know last week or about a week and a half ago, we went to the 6-month inverted with the 10-year. So it's going further to the left. And then I looked, but it was only maybe a couple basis points. And then Sunday I looked at it and the 10-year was like at 2.75 or 2.78. And then the 6 month was like 20 basis points higher. Yeah. I'm like, whoa, this is really getting dramatic. So maybe walk people through why that's important, what we've seen with the treasury curve over the past couple of months, and then we'll go into the fiscal and monetary response.
Yeah, with curves, it always starts out in the outer years, because the outer years are where the markets are more independent minded. They're doing growth and inflation expectations. Irving Fisher, going back to the decomposition of yields. So there's less influence of short-term things, including the Federal Reserve's ability to affect the shorter-term end of the curve. So what you usually see is that when something starts to bother the market, when enough people in those markets are starting to hedge against an uncertainty in the future, you'll see a little bit of a tiny blip down the curve. That started in the Eurodollar futures curve all the way back on December 1st.
Right.
And it was in this way distant December, I think it was the 2025 contracts way down the road. And it was only a single basis point.
Yeah, I remember you talking about it.
Even that was enough to say, this is a oh shit moment, because
right.
the market, for any kind of curve that should be upward sloping, for it to flatten out to the point that it even inverts even a single basis point, because you got to remember, in these markets, you have huge money players who have every incentive, if they see something like that happen, an inversion in the curve, to take the other side of the trade, to say, this is crazy. There's nothing going wrong here. And if nothing goes wrong, I'm going to make a ton of money because this curve is out of shape. So what happens is you have that little bit of inversion, which is enough of the market beginning to hedge and not enough of the market taking the other side of the hedge, so that it starts to show up. And if that uncertainty, if that risk that the market is perceiving grows and it starts to be accepted by more and more parts of the market, then you see the inversion start to spread. It gets further in terms of depth. It becomes bigger, not just a basis point, might become a couple or 5 or 6, and it will move further and further up the curve as more and more of the market starts to come around to this risk view. So what happens is you have this tug of war between different viewpoints, where if nothing was going to happen, if the market believed everything was fine, everybody would arb that inversion away. It would just disappear. But if more and more people come around to the hedging side, then the inversion grows. So as we see the inversion grow and spread further and further closer to the front of the curve, that is the market becoming more and more certain that what everybody's hedging against is actually going to happen. Because remember, this is all about probabilities. So the more inverted, the closer it gets to the front of the curve, the more certain the market is becoming. And then you sort of make judgments about what it is that they're hedging against, how soon, how deep, how bad, and all sorts of other different probabilities. But by and large, when you see inversion spread, whether it's Eurodollar futures or the treasury curve, same thing, closer it gets to the front, the deeper it gets, the more you know the market is okay. There's almost nobody left that's going to take the other side of the hedge trade. So these curves become very distorted. We saw it in the treasury curve. It first inverted to 7 to 10 year spread back in March. And then, as is normally the case in inversion, the inversion disappeared, then it came back and it disappeared and went in and out over time, which is just the market sort of debating all the dynamic probabilities. And then really since April, it's kind of been, okay, completely inverted. And then that inversion is moving closer and closer to the front. As you said, George, right now, the 6 month is inverted to the 10 year as well as the 30 year. So it is incredibly upside down, because the market is saying all of it uniformly that the Fed has only got a couple more rate hikes in it before whatever happens, and they stop hiking rates. They reach the terminal thing, the terminal level, and likely they start going the other direction.
Right. Okay. So that takes us to the monetary and fiscal. Let's just assume the Fed drops rates down to 0, that would be an environment where they would, even the White House would have to acknowledge that we're in a recession, right?
I don't know. They could get really creative here. They could, I'm sure, don't put them past them to say that, hey, this is not a recession. This is some new term that they could come up with.
Yeah. And I think you and Emil were talking about how the Fed came out with an article the other day saying just completely ignore the 2s and the 10s. It's all about the Fed funds and the
short-term
spread, something like that.
Yeah. There's this whole academic argument that yield curve inversion doesn't matter until it reaches the front. And Emil and I were just flabbergasted, because we say it always starts and then it reaches the front. So why would you ignore it when it starts in the back and only pay attention to it when it finally gets to the front? Well, their argument is that the Fed won't make a mistake and they could possibly rescue the economy before it gets that far. And what Emil and I were laughing about was the fact it never happens.
I think it's
never. Once the inversion starts, it's going to get to the front at some point.
I think it's all about the White House thing, just them trying to say, "Oh, nothing to see here, nothing, move along, nothing to see here."
But at some point, doesn't it make it worse? Because let's say you're Jay Powell and you're thinking, all right, first of all, I didn't want to hike rates to begin with because this transitory stuff, I didn't really go along with it. But okay, I got to hike rates to make it look like we're doing something about consumer prices, and so we did that. But now it's become very clear. Even some of the Fed models are saying the more likely recession than not. You would think that Jay Powell would say, okay, no matter what the Fed or what the White House is telling me, I got to at least say something that looks like it's going to be realistic, because something is going to happen over the next 6 months, and you can't spend all your credibility in denial, because once you do that, there's no going back.
Yeah.